We are almost done with our seasonality talk as we come to the end of the year. I don't really cover seasonality all year, but I think when it comes to hedge fund positioning and taxes and things like that, that is where seasonality shines. And we have another one here that I think is very interesting into the end of the year, and that is called the first 5-day indicator. And simply speaking, it's looking at what is happening for the first 5 days of the year, the first 5 trading days, and is that a positive or negative return? And if the first 5 days are positive, you have an 80% chance that the year is positive. That sounds crazy until you take a step back and you realize it's about a 75% chance that you're positive every year, regardless of what happens. You're up about 70 to 75% of the time, depending on your look back period. But what's significant, I think, is that if we look over here, if we're positive those first 5 days, the average return for the market was 15.9%, let's just say 16%. And then the average return, if you were negative for those first 5 days, considering again, you're up most times, you're up 5%. So you get almost a 3 times better return on the market on average if you're up the first 5 days versus if you are down the first 5 days. So that becomes very, very important. And if you combine that with this chart here, which is just looking at the January barometer as well, which is just how did we perform in January, if we have a positive January barometer, we have about 85%. But if we have a positive 85, or sorry, positive first 5 days and a positive January, then we have an 86% chance of being higher. And again, the magnitude is what's interesting here. So this is one that there's nothing really to do until after. It's just important to observe what's happening. Now, why do I think this works and why do I actually follow this? Well, I think this works and it makes perfect sense because we know that hedge funds in the new year, after the tax season is done, will start to position themselves based off what they think is going to happen in the market. So if a hedge fund and hedge funds en masse, the majority of the market participants out there when it comes to money, if they are very bullish, they're going to position positively. They're going to buy stocks. And if they're bearish, they're going to sell stocks or short stocks. So just watching what these guys do right out the gate, as soon as liquidity comes back in the market after the holidays, and as soon as the tax season is over, watching very closely to what they do becomes very important and very interesting and illuminating for what can happen for the full year of 2026. So we want to kind of sit back. We want to watch the S&P 500 mark, the beginning of the year, and then the first 5 trading days. And then from there, we can kind of take a look. Now, it doesn't mean you just buy it when it happens, but it just means that you might have a tailwind, and doing this kind of level setting for the year, I think, is important because now okay, if these two indicators line up and we have the Santa Claus rally, which we're still working through and all of that, everything is seasonality strong. Well, you want to look a little bit more for the buy side. If some negativity or some weakness comes in during this period of time, maybe it's time to look a little bit more to the other side. So again, nice guides, not actual trading signals. If you want trading signals, you go to StatsEdgeTrading.com. We build algorithms that output trading signals. I always just like to keep an eye on whether the wind's going to be at my back or not. And that just kind of gives me confidence to place my trades when the signals come through. And until I talk to you guys next time, have a happy holiday. That's another holiday with New Year's, and get away from the screens. And we'll get back to our normal scheduled program next week.